All right, let's talk about the US. We'll talk about the pound. All right, and we'll talk about the euro and the Aussie. All right. Okay, and this is, I'm doing this as generically and sort of basically as possible, but it's probably all you need to run with, to be honest with you. Okay, the number one fundamental rule with trading is yield. Okay, money will flow typically to the currency that's going to give you the highest yield or the highest expectation of yield. All right, because although the Aussie is 2% rates and the dollar 0, all right, or 2 versus 1, it might not be a lot for us, but you leverage that up a couple billion, it starts to be real money. All right. Cash flow is going to want to migrate to high yield. It's just the way it is. All right, principally speaking. Okay. Now, although we have the Chinese economy growing rapidly, you know, Asia's still growing at 6%. This is my thing too about Asia is that, you know, oh, China's not the growth story it was. Yes, you're right. It's come down because of just and I'm going to explain that. And I'm going to explain exactly that, Ruben. Because it's relative to where it was and the cycle that it's in. Because it's what happens in reality in the moment of what you're looking at is one cycle behind what's being traded. Okay? So although the US economy is falling out of favor, it is still the benchmark for what goes on in the world. Meaning this, if the US gets a cold, the rest of the world will get flu. All right? It is still the knock-on, it is still the benchmark currency, the benchmark economy for what other economies react to. Okay? Right. All right. Meaning this. If the economy is hot, all right? If the economy is hot and inflation's rising, generally a central bank will want to raise interest rates, right? Want to raise rates to cool down the economy. It's Ecos 101, right? And if the economy is cold, inflation's down, employment's dropping, generally they'll want to cut interest rates so that it increases lending, blah, 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 blah. All right? Okay. And in the process, the value of the currency is depreciated, etc. Okay. And in today's day and age, we have QE thrown in the mix there too, which is part of this component. Right. Now, the interesting thing about the world is this. Okay? The US, the Fed, they are concerned with a dual mandate. Okay? Price control and growth. Okay? Price control and growth. All right? So, dual mandate for these guys. Dual mandate here. Single mandate here. Dual here. For the most. Okay? So this is an interesting proposition all in itself, isn't it? Because as long as these guys are hitting an inflation target, that's what determines the interest rates. Right? Meaning this. What is a mandate? Meaning this. The Fed's job, all right, the Fed's, why they went to Jekyll Island and sat around the table to get out this Fed thing, was principally to control two principal jobs. All right? How to control price inflation in the market, as well as economic growth. Okay, and it's the same for Bank of England. However, the European Central Bank, they don't have this double job. Their single job is price inflation, which it's starting to bleed into a dual mandate now. It is. But principally, they only care about inflation. Okay? And that's why, even though the European numbers that come out every day, oh, we're missing GDP, we're missing, I've sat for 2 weeks and watched the eco numbers come out for Europe, and they've missed. Germany's been okay, but everybody's just missed, GDP, all of it. All right? Why hasn't it clobbered the euro? 2 reasons. One, we're still printing money like a drunk sailor here in the United States. Okay? And then 2 is that the Europeans, in theory, they're going to run themselves into a massive recession, in my opinion. But relative to what the United States is responsible for, morning, Martin, right? Relative to what the United States is responsible for, that's okay for them to see. That's okay for them to see these sort of deflationary numbers as long as they don't see tremendous inflation. All right? And this is why the euro has actually got this relatively bullish posture relative to these other currencies, because their mandate is different. However, their fundamentals are weaker. Okay, this is confusing now, but I'm going to get to my point in a minute. All right, now, if the United States economy, right, which typically lead the rest, starts to cool off a little bit, okay, and the Fed comes out and starts a cutting cycle, all right, the dollar is not necessarily going to weaken in this phase. All right, and I'll explain further here in a minute. All right, and the pound, because it's lagging a little bit, maybe 3 to 5, 6 months, all right, their interest rates may be flat. Okay, and the Europeans might be sort of just plateauing off from raising rates. Okay, and the Australians might be in a sort of an inflationary cycle. All right. So interest rates down here in the States, flat for the Bank of England, kind of marginally up, sort of plateauing out for the euro, and rising for the Aussies. And like I said, I'm doing this in a generic fashion. Okay. Then the economy improves marginally here in the States, and interest rates flatten out. The pound starts to drop. Europeans are flat. All right. And the Aussies are slowing. Okay. And then say the economy starts to improve here in the States, start to raise rates, flatten here, cut here, and flat here. All right? This is the very basic, very generic, take quantitative easing out of the mix, economic cycle of the world as we know it. The US leads it, everybody else follows, and the interest rate cycle continues. Okay, now, one would expect, can one hedge if you have 2 accounts, not on the same account? I mean, it depends where you live, Greg. All right, so one would expect that in this phase, the dollar is dropping. And in this phase, the dollar is sort of sideways, and this phase is rising. This is not the case. Okay? This is not the case. In reality, I don't hedge typically. I just pick a bias and go with it. This is not the case, guys. Alright? Typically, if interest rates are dropping, okay, if interest rates are dropping, the currency has already dropped.